Good afternoon, everyone.
Good afternoon,
Good
sir.
afternoon, sir.
Good
Hi,
afternoon.
sir.
Hello, good afternoon.
Good afternoon, sir.
Good afternoon. Cool. So we are back and we'll be looking at two accounting standards today, which are quite interconnected with each other. One is IAS 19 employee benefits, and the other one is IFRS 2 share based payments. Now, IAS 19 has a higher I have seen IAS 19 getting tested more in the SBR exam as compared to IFRS 2. So when I was analyzing the exam kit and all the past exam questions, IAS 19 I saw on at least three times more the number of occasions as compared to IFRS 2. Of late, in the last 2 or 3, maybe in the last 1 year or 1.5 year, there have been a couple of interesting questions on IFRS 2 that have been tested in the exam. But apart from that, it's pretty straightforward in terms of the kind of questions that are asked. They have asked stock appreciation rights once. They have asked a performance-based condition once in IFRS 2. And yeah, that's pretty much all that has been tested. Apart from that, IAS 19 employee benefits, specifically the treatment of all the different items in terms of specifically how exactly do you account for a defined benefit plan, what goes where, which heading should a particular item go in. And then there have been situations where they have also tested that in consolidation. So consolidation questions may, I think you will see a lot more of IAS 19 than in a standalone question. So, and that to defined benefit plan, it has a higher propensity of getting tested as compared to a defined contribution plan. On a certain level, the difference between the two, how does a defined benefit plan work and how does a defined contribution plan work, uska ek question type has been once they have asked a question on what is the difference between the two types of plans, but and that has been a theoretical question, so to say, not so much as a practical focused question. Okay, so let's start with IAS 19 first. We'll do exactly what we did yesterday. We'll revise the entire standard from a bird's eye view. And after that, we'll see what kind of questions have been tested in the past. So you will get the PPT and you will get the Excel sheets. Both you will get. Students who have been with me for the entire batch, I don't think you need another round of Excel sheets because you already have everything. So the Excel sheet is not so much for you, but the others I will be sharing it on the separate group. So don't worry about it. ठीक है IAS 19 employee benefits में basically there are four types of benefits that we should be aware of. Which are these four types of benefits? These are post-employment benefits, that is after you have retired from the organization, after your superannuation, the benefits that come your way, those are considered as post-employment benefits. Now, it is important for you to remember that these calculations or this accounting is not happening for the recipient of employee benefits. It is happening for the company which is paying these employee benefits. Then there are short-term benefits like your salaries and wages and bonus and all of that. Then there are termination benefits. Termination and post-employment, what is the difference between the two? When I talk of termination benefits, maybe a person has been asked to leave the organization. Okay, the individual has been asked to leave the organization on account of maybe redundancy, on account of maybe some restructuring. Those termination benefits are those. Retirement is where you have reached the age of superannuation. And what is the age of superannuation? 58 in some countries, 60 in some countries. So that changes. And then you have other long-term benefits. Other long-term benefits could be, some sort of a share-based payment plan or certain other long-term incentives that are given. So those could come under this category. When we think of short-term benefits, these are probably the easiest one to account for. And for what reason? There are hardly any actuarial assumptions involved. Basically, your monthly salary, your monthly, maybe, your quarterly bonuses that are given to you or advance given to employees. So all of those items are primarily covered here. Your monthly entry, salary account debit to cash account or salary account debit to salary payable to bank. That's the only kind of accounting entry that you should be concerned about. Straightforward accounting, and nobody really is interested in asking you this. What they are interested in asking you is the post employment benefits. Now, please understand, when I use the term post employment, what I want to say is that after an individual retires, what are the benefits that he would get on account of his employment? Suppose I am working with the company Plutus Education right now. Now, what Plutus Education does, on the directive of the government, see, the government knows that if Satyamed is left to his own devices, he will सारा पैसा उड़ा देगा, and at the time of retirement again he will come crying कि अरे मेरे पास पैसा ही नहीं है. So what Plutus Education has to do on behalf of the government or as a part of the government advice, every month the company has to deduct a particular amount of, say my total salary is 5 lakh rupees a month. From that, Plutus Education has to deduct a certain amount, say 5,000 rupees, and it has to deposit this amount with the government authorities in the form of a provident fund or a pension fund. Okay. And they deposit, so Plutus Education deposits the amount. A particular amount is deducted from my total payable also, and this amount keeps on getting accumulated over my entire course of employment. And it is only when I retire that I get access to that amount. I cannot access this amount before I complete my tenure of work and before I reach the age of 58 or 60, whatever is the superannuation age. So employers have to deposit a certain amount with the government authorities, or they are made compulsorily to create a separate fund called the pension fund, where they have to keep on depositing amounts each and every month. Her month, in every month, they have to deposit a fixed amount in that account. You could call it provident fund, you could call it social security, you could call it pension fund, you could call it by many, many different names. These are basically your post employment benefits. So, right now, if Satyamit starts working with Plutus Education, Plutus has to deposit a particular amount, say 5,000 rupees each month, in a separate account, which I can access only when I reach the age of 60. That separate account is known as a Provident Fund account. A Provident Fund account is where all the amount gets accumulated and deposited by the employer year on year. And at the end of my retirement, I can claim that particular amount. Now, there are two ways or two types of circumstances under which money gets contributed to a fund. Okay. Now, these two methods of making contributions are called the defined contribution plan and the defined benefit plan. Now, to keep things simple for you, defined contribution plan is where the amount of contribution is fixed. जैसे 5,000 every month. This could be one way of fixing the contribution, or it could be, say, 2% of your gross salary, which would make it 10,000 every month. So either the contribution is fixed or the method of calculating the contribution is fixed. The company could decide कि यार हर महीना we'll contribute 5,000 rupees to this account, or they could say कि यार जो भी employer का salary है उसका एक fixed percentage I will contribute to this particular account. So in a defined contribution plan, the amount of contribution is fixed. The final benefit payable is not fixed. अब क्या होता है, this 10,000, 10,000, 10,000 keeps on getting accumulated every month. And you know what the authorities do is they accumulate the money and they invest that in different income generating assets. They could invest this money in gold, they could invest this money in government securities, they could invest this money in shares. जैसे म्यूचुअल फंड करता है ना, समथिंग सिमिलर. So ऐसे they keep on accumulating the money, and that money keeps on getting deposited. Whatever return is earned on that, that return gets credited to the individual contributor's account. And when he retires, then whatever is the value of the fund on that date, that much money is disbursed to him. Suppose this 35,000 is invested in 100 shares of Reliance. 350 shares हो गए, each share is worth 100. अब when I retire, each share is worth, say, 300, and each share is worth 600. तो कितना हो गया value? The value is 2,10,000. So whatever is the value of the fund on that particular day, utana paisa will be given to me. What was fixed throughout my working cycle, kitna amount contribute hoga, that amount was fixed. How much amount I have to contribute to this particular account, that amount was fixed. The benefit was not fixed. A defined benefit plan is something in which the amount of benefit is fixed. The amount of contribution is not fixed. Up to understand this, let me show you something as a part of, how the defined benefit plan works. Just give me one moment. I'll have to log into my account. Just give me one moment. I'll show you on screen how a defined benefit plan works. Okay. Okay. Can you see my screen? I have opened my Demat account for you. Now, this is a goal calculator. Okay. So, say for example, I have promised a benefit of 5 crore rupees to my employee on retirement. Okay. That when the individual employee retires after, say, 25 years from now, he is going to get 5 crore rupees. What is the duration to achieve the goal? 25. And what is the expected rate of return? The expected rate of return is, say, okay, let's take this one. Uh, Say we want to get Mayank married. Okay. So for his wedding, we need 5 crore rupees. What is the inflation rate in the economy? Say 8% is the inflation rate. What is his current age? He is 20. What will be his age when he gets married? At that time, his age will be 30. And what is the expected return on the investment? The expected return is 20%. Okay. So once I input this number, what do I get? I get how much amount should I contribute every month or how much money should I invest today? So by the time he reaches the age of 30, I should have 1 crore rupees with me. Now imagine one of the factors undergoes a change. What undergoes a change? The inflation rate in the economy drops down. Now, when the inflation rate in the economy drops down, see what happened here earlier, the rate was 8% and I had to invest 57,404 each month. Now, if the inflation rate is 6%, you see the number reduces, it becomes 47,617. Basically, what I'm trying to show is that the benefit is fixed. When different parameters undergo a change, the amount of contribution every month changes. Maybe he wants to get married earlier, not at 30. He wants to get married at 28. So see again, the amount of monthly contribution undergoes a change. Basically, what I'm just trying to prove here is that the total benefit promised is fixed. But what change once these factors undergo a change, inflation rate changes, expected rate of return changes, or the target period changes, the monthly contribution also undergoes a change. This is a defined benefit plan. So, what is a defined benefit plan? A defined benefit plan is something where the final benefit is fixed. But if certain factors change, if inflation changes, if rate of return changes, if other things change, you will be forced to change the amount of monthly contribution. That is a defined benefit plan. What is a defined contribution plan? The amount that you contribute to the fund, that amount is fixed. Or the method of calculating that amount is fixed, which could be 2% of salary, 6% of salary. That is also a defined contribution plan. A defined benefit plan is where the final benefit payable to the customer is fixed. Okay. So if you want to distinguish between the two, what is a defined benefit plan versus what is a defined contribution plan? The rule is very simple. In defined contribution plan, the amount of monthly contribution is fixed. The final benefit will change. In a defined contribution plan, the final benefit is promised and fixed. In order to achieve that target, you will have to change the amount of monthly contribution if the circumstances around you, like inflation, rate of return, and these things undergo a change. So this is something that you will have to be careful about. Now, rarely do you get questions on deciding whether a plan is a defined benefit or a defined contribution plan. But if at all you get that question, please keep one thing in mind, that this basic rule of what is fixed. Ask yourself that question, what is fixed in this case, and that will help you to decide the future course of action. If you are looking at a defined contribution plan, what is the accounting entry? Employee benefit expense account debit to contribution payable. So you recognize an expense and you recognize a provision immediately. And when you make the payment to that respective provident fund account or pension fund account, you record an entry contribution payable account debit to bank account. ठीक है. अब say, for example, an entity makes contributions to the pension fund of employees at a rate of 5% of gross salaries. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages are 2.7 million. How much is the contribution? See, the amount is not fixed, but the method of calculation is fixed. It is a fixed percentage of the gross salary. So if the gross salary is 27 lakh, the rate of contribution to the pension fund is 5%. And what is the total expected contribution? 1,35,000. So throughout during the course of the year, you should be contributing 1,35,000 to the pension fund. Now, what you did in this case is you were paying 10,000 each month. So each month you were recording an entry, employee compensation expense account debit to pension to bank account. Yeah. Pension fund contribution expense account debit to bank account. You recorded 12 such entries. Total amount of expense recorded is 1,20,000. You realize that the actual charge should be 1,35,000. So at the end of the year, you recorded the payable entry, a pension fund contribution expense account debit to contribution payable, and then contribution payable to bank. ठीक है. Defined contribution plan is very, very straightforward, which is why it is not even tested so frequently in the paper. ठीक है. अब what is tested more frequently in the paper is the defined benefit plan. अब defined benefit plan में there are quite a few individual terms that you need to understand. Now, what are these? These are plan obligation, plan assets, service cost, net interest component, so on and so forth. Now, for this, now, please pay attention to how the mechanics of a defined benefit plan work. What happens is, say how many people are here? There are 25 people here apart from me. What I do is I collect money from each one of you. 1,000 rupees I collect from each one of you, and I take that money from you. And right now, when I collect that money from you, it is an obligation. It is my liability. That is not my money. I have simply collected the money from you. And what am I doing with that money? I actually can't use it for playing Dream 11, right? That money has to be used to secure your pension benefits. So I collect 1,000 from each one of you. I have 25,000 rupees with me. That 25,000 rupees is my obligation. But I don't let that money remain in my bank account. I take that money and I deposit that in some income generating asset. It could be gold, it could be shares, it could be government securities, it could be FDs, it could be any of these things. So these items in which I invest this money, these assets are known as plan assets. And the money that I have collected from you is known as my plan obligation. Plan obligation is the amount that is payable to you. Plan asset is where exactly have I invested that money to secure your pension benefits. So there is a plan asset part and there is a plan obligation part. Okay, this pension fund obligation, see, it will depend upon the number of employees. जितने employees आएंगे उसके हिसाब से I'll have to calculate my monthly contribution. I'll have to keep on accumulating that account amount, but it is not my money. It is money that I have taken from you, which ultimately is payable to you, which is why it is shown as an obligation, which is a plan obligation. And I have used that money, invested that in different assets to secure your pension benefits and give you the return that is promised. So the places where I invest that money, that is known as my plan assets. Okay, so pension fund collects money from 10 employees, 5,000 each. This money is collected from the employees and the fund has promised a certain amount of benefit. So even though this 50,000 is in the custody of the pension fund, ultimately this amount belongs to the employees at the end of the day, which will have to be paid to them when they go out. So this 50,000 collected from the employees is known as plan obligation. When I collect the money from you, I debit my bank account and I credit my pension fund obligation. Now, assume that on 31st of March 2025, the present value of the obligation is 50,000. But in 2026, one employee leaves. That means now you don't have to contribute money for this employee, and two new employees join, and they have a different salary structure. So naturally, at the end of the next year, the value of the pension fund obligation will be different. That value is the change in the fair value of the pension fund obligation. Now, this money that I have collected from each one of you, this 50,000, I will deposit that or invest that in different assets. 20,000 I invested in shares, 5,000 I invested in bonds, 10,000 I invested in mutual funds, 15,000 I invested in gold. So overall, I invested all the 50,000. Now, what is the accounting entry for that? The accounting entry for that is naturally shares account debit, bonds account debit, mutual fund account debit, gold account debit to bank account. So this is the accounting entry for plan assets. Okay. On 31st of March 26, the fair value of, see, this was the entry I did on 31st of March 25. I took money from you and I invested that in a separate account called the plan assets. Now, at the end of the year, the value of these assets have changed. As the fair value has changed, record the change in fair value in your books of accounts. So, the whole point of telling you this story was you should know what exactly is plan assets and what exactly is your plan obligation. Plan obligation is a promise or commitment to pay, and plan assets are those avenues where I have invested the money to fulfill the plan obligation. To honor the plan obligation, I have invested my money in all of these assets. Okay. So what we do in the balance sheet is one way of doing that could be show the obligation on the liability side, show the plan assets on the asset side, and keep your life simple. Or another way, see, think about it, that plan obligation you have, and then there are plan assets. Why do you have these plan assets? Only in order to fulfill the plan obligation. So both of them are like two sides of the same coin, which is why you net it off and you show the net amount in the balance sheet called the net value of the plan obligation. Or if the value of obligation is greater than asset, like value of obligation is 1,000 and the fair value of assets is 900, show 100 rupees as the net amount in your balance sheet. Now, what happens is every year you have to calculate the interest obligation on that. Now, why do I call it interest obligation? Please understand. Now, there is a person who's working with me and I am supposed to pay her 5 lakh rupees at the end of her employment. Okay. And I know that I have to pay her 5 lakh rupees. So, and that too, I have to pay this money to her after 5 years. So, what I do today is I record the obligation at the present value of that 5 lakh rupees. After 5 years, I have to pay her 5 lakh. So today I will record the obligation in my books of accounts. IAS 37, present obligation as a result of past obligating event. All of those conditions are fulfilled. Today I record the obligation at 3,10,500. Now what has happened is that an entire year has passed. We on 1st of April 2025, I created the obligation. We have reached 31st of March 2026, but yet no payment has been made. So what I will have to do is I will have to record an amount of finance charges or interest for one simple reason that an amount is payable to another person. I recorded the liability. An entire period of 12 months passed by, but I did not pay the amount. Naturally, that comes with an interest. Any amount, if not paid on time to the creditor, will create finance charges. So the liability at the end of year one will be opening amount of 3,10,500 plus 10% interest, which makes it 31,050. So liability at the end of the year is 341,550. Now, what happened was, uh, when I knew that I had to pay 5 lakh rupees to an employee. So today I created a provision for 3,10,500 and I'm going to keep on adding to that provision on account of interest charges. Now to honor that obligation, what I did, I took this money and I invested that in some assets like FDs, golds, bonds, whatever. Again, 1 year passed. These assets in which I had invested my money, those yielded an interest of 20,000. Those yielded returns of 20,000. So what is the fair value of plan assets? 3,10,500 plus 20,000, that is 3,3500. So at the end of year two, slash at the start, sorry, at the end of year one, The value of my obligation is 341,550. The fair value of my plan assets is 330,500. There is a net obligation of 11,050. Now, think about it. On this net obligation, see, present value of plan obligation at the start of the year 2 was 341,550. Finance charges are 10% per annum. Okay. So finance charges for year 2 will be 341,550 into 10%, that is 34,155. I'll have to show that as an expense in my P&L account. These are my assets. I expect them to yield a minimum return of 10%. If I have invested in different investments like FD, gold, bonds, etc., and on that I earn 10% interest, then 33,050, which is 10% of the amount invested, that will be my income. And on the debit side of P&L, I show interest of 34155, and on the credit side I show income of 33050. What the accounting standard specifically now tells me is ki Satyamit, anyway these both relate to the same item, so instead of showing an expense and an income, why don't you show a net finance cost impact of 1105, which is 34155 minus 33050, or in short, on the net obligation amount, calculate 10% interest and show that as finance charges in books of accounts. If the value of obligation is greater than the value of plan assets, obligation payable is more, asset value is less, there will be a net interest expense that I will have to record in the P&L on the debit side. If the value of plan assets is more and the value of the obligation or the value payable is a smaller number, then in that case there will be a net asset position and it will lead to interest income. Okay, just have a look at this once, interest on the net obligation part. And if you have any questions on this part, please let me know. Are you with me, all of you? Any questions?
Sir.
Anyone? Okay, now let's understand what is the meaning of the term service cost. See, when an employee starts working for the company, you have to pay him salary. But when an employee starts working for the company, it is now your responsibility to contribute to the pension fund or contribute to the provident fund for this particular employee. So the amount that you contribute to the pension fund or the provident fund, because this employee is working with you, that amount is called service cost. Service cost is not the salary paid to the employee. Service cost is the amount that you contribute to the pension fund or the expense that you incur basically because this particular employee has been working with you. So service cost is not salary, but service cost is when an employee works for the company, he becomes entitled to get these benefits from the company. These benefits means pension benefits, provident fund benefits, all of that. So the moment an employee starts working with the company, the moment he gets in service of the company is obligated to pay some benefit to the employee. That benefit ka cost is known as the service cost. Now in your profit and loss account and OCI, let us see what is the treatment. You start your opening calculations with net value, so opening net value of obligation, which is PV of obligation minus fair value of plan assets. To that you add the interest on net obligation, which is always calculated as a percentage of the opening. Add current and past service cost, less contribution made to the plan, add or less impact of curtailment, gives you the closing carrying amount or closing net book value of obligation. Compare that with the closing net fair value of the obligation and once you compare these two values, the difference between these two values, the book value and the fair value, that difference goes to other comprehensive income. Now See, why do you think is the fair value different? The book value is calculated, by the way, on the basis of the accounting transactions that have taken place and the actual movement in that particular balance. But the fair value of a particular obligation or a set of plan assets is estimated or calculated depending upon the market conditions, depending upon inflation, depending upon a lot of actuarial assumptions that are used here. So any gain or any loss means the value of obligation has gone up, but it is an on paper increase in value because of inflation and other changes. It is not an actual change yet because you are not settling the obligation right now. So this change in fair value is also called as actuarial gain or loss. But because it is not a realized gain or loss, it goes to your other comprehensive income. It is not recorded in P&L. So remember this format for the paper. Opening net value of obligation. What is opening net value? PV of plan obligation minus fair value of plan assets. उसमें you add the interest impact, then you add current and past service cost, less contributions made to the plan, add less impact of curtailment will give you the closing net book value of the obligation. Uh, Compare that with the fair value. The difference between these two is called the remeasurement component, which could be an excess or which could be a shortfall. And this amount gets routed through other comprehensive income because this is a notional calculation right now. These gains or losses are unrealized. Hence, that is routed through the other comprehensive income part, not routed through your profit and loss account. So this is your basic idea of how exactly is the defined benefit plan accounted for. See, this opening net book value that goes to balance sheet. Closing net book value goes to balance sheet. Okay. Interest on obligation goes to P&L. Current and past service cost go to P&L. Uh, Impact of curtailment also goes to P&L. This contributions made to plan amount that is deposited in the plan that does not go to P&L. That is basically routed through the cash flow. Okay, so this is one format that I would want you to remember for your paper and just make a mental note of what goes where. Okay, have a look at this. If you want, you copy it down. I'll just have a glass of water and come and then we'll continue. So from an examination perspective, given that you have only a week for the exam, you just have to remember what goes where. All of this story is only for your understanding. What matters in the exam is this treatment in P&L OCI and what goes where, what is called remeasurement component and how it is recorded in the other comprehensive income. Now, plan assets could be a wide range of assets. You could invest in bonds, you could invest in gold, you could invest in any of these items, or you could also take an insurance policy. Now, why would you take an insurance policy? See, for example, you have an obligation to pay 5 lakh rupees to someone, and there is a concern because of the changing market conditions that on that particular day, when the amount has to be paid, on that day, you might not have enough money to make the payment. So, in that case, you will need, and see, employees are not going to forgive you if you have promised them 5 lakh rupees at the end of fifth year and you don't have enough funds. They will come with sticks and stones at you and they will beat you up. So in such cases, what you do is you take an insurance policy that in case there is a shortfall in the amount that you have to pay, you don't have enough money, the insurance company will compensate you for that. Such an insurance policy is called a qualifying insurance policy. It is also included as a part of the plan assets. Now, the service cost part could be a current service cost, that is, every month as the employee keeps on working, you calculate the amount, and that is the current service cost. It could so happen in certain cases that the employee was working for you in the past and or he has been working for you and suddenly the company decides to increase the rate of the pension fund contribution in a retrospective manner. Now, when the company decides to increase the contribution in a retrospective manner, that would become the past service cost. Okay, now I'll show you a simple question to help you understand how exactly does the calculation and accounting work. I see a question in the chat box. Does the opening net value change if there is a plan surplus? So in that case, it is called a net asset position. Otherwise, we call it a net obligation position. We do have those situations as well where the value of assets is more than the amount of liabilities. We'll study that under the heading asset ceiling, ki how to tackle that part. Okay. Let me show you a simple question which basically forms the base for a lot of other calculations that you will do. Okay. So the following information is provided in relation to a defined benefit plan operated by Selim. At 1st of Jan 2004, the present value of obligation was 140 million and the fair value of the plan assets amounted to 80. So this is value of the obligation 140, value of assets is 80. Okay. So present value of obligation is more than the value of the asset. You have a net liability and net obligation position. So obligation greater than assets, you have a net obligation position of 80. Okay, now let's talk about the year 2004. What is the opening net value of the obligation? On this date, 140 is the present value of obligation, 80 is the fair value of assets. So the net value of the obligation is how much? The net value of the obligation is 60. Okay. Now, in the year 2004, the discount rate at the start of the year is 4%. You will use this for the purpose of calculating the finance cost. Add net interest component at the rate of 4%, 4% of 60. Then you add current and past service cost. How much is that? 30. Both of these values will go to P&L, by the way. Less contribution made to the plan, which is 25. That is the amount of contribution made to the plan. Uh, you will get the carrying amount of the obligation, which is 60 plus 2.4 plus 30 minus 25. The carrying amount means value in the books of accounts is 67.4. But at the end of the year, okay, present value of obligation at the end of the year is 200. Fair value of plan assets is 120. So value of net obligation is 80. So fair value of net obligation is 80. Carrying amount is 67.4. That means you will have to increase the amount of obligation or liability in your books of accounts. The difference between these two, 80 and 67.4, which is 12.6. This is known as the remeasurement component. What is this called? This is called the remeasurement component. This amount goes to other comprehensive income. Whereas your interest, your current and past service cost, these amounts go to profit and loss. Okay. Now you go to the next year, which is the year 2005. The closing amount of 2004 becomes the opening amount of 2005. In 2005, the amount, the discount rate is 3%. So you apply the rate of 3%, you get interest. You add the current and past service cost of 32, which is given in the question. Then contribution paid is 30. You subtract 30 here. What do you get? You get the carrying amount of net obligation as 84.4. How did you arrive at this number? 80 plus 2.4 plus 32 minus 30. Okay, you compare that with the fair value of net obligation, which is 5.6, the difference between the two. This difference goes to other comprehensive income. Now, whenever you have a question on a defined benefit plan, this is one approach of looking at things that you should always incorporate. Learn the format for IAS 19 and make sure that you apply that in all the cases. Now, it is highly possible that you would have situations where the benefit given to the employees or the quantum of benefit given to the employees is reduced over a period of time. Earlier, I had 300 employees and now 100 of them have left the organization because their work became redundant and I did not require their presence anymore. In this situation, what I will do is in the future, I will not make any contributions in favor of these specific employees. This is where the idea of curtailment comes in. A curtailment is a significant reduction in the number of employees covered by a pension plan. This may be a consequence of employees being made redundant. The employees have left the organization because, or they are about to leave the organization because their skills are no longer required. So what is happening is in future, your obligation is going to go down because Earlier, you were responsible for 200 employees. Now 40 of them have been made redundant. So now you are responsible only for 160 employees. So ideally, what you should do is you should compare two things. You should compare the present value of obligation. You should compare that with the fair value of plan assets before the curtailment. Compare that with the value after the curtailment. Okay. So if value of net obligation before curtailment is more than the value of obligation after curtailment, the difference is called gain on curtailment, which goes to P&L but is adjusted against service cost. It is not credited to P&L. Usually A less than B will not happen. Why? Because if you are reducing the coverage for number of employees under the plan, then liability will most probably get reduced only. Okay. So value before curtailment less than value after curtailment will not usually happen. But if it does, because for whatever reason, the difference goes to P&L and it gets added to service cost. There are there is a question on curtailment in your एग्जाम किट एक जगह पे है इस पे क्वेश्चन. ठीक है. Now, because of curtailment, what usually happens is the amount of liability goes down, because now in the future you will be responsible for a lesser number of employees, but on the amount of plan assets remains the same. The amount of plan assets does not change, and whatever is the difference in the values at this stage, the difference in the values before and after curtailment, that is the gain on curtailment, which gets adjusted in the service cost. You can have a look at this question where before the curtailment, the present value of the obligation was 6 lakh. It is estimated that after the curtailment, this will reduce the present value of the future obligation by 10%. So 6 lakh will become 6 lakh minus 10%, that is 5 lakh 40,000. Compare this with the fair value of plan assets, which is 5 lakh. Your net obligation has dropped from 1 lakh to 40,000. There is a gain of 60,000. The value of the obligation has gone down by 60,000. Okay. This is gain on curtailment, and this should ideally get credited to profit and loss account, but you will not credit it to P&L. You will adjust it against service cost. This is a situation of curtailment without settlement. That is, you have reduced the liability, but the final amount is not payable right now. Final amount will be paid later. Just have a look at the question language once before we move on to the next one. Okay, perfect. Anything that you want to ask, please let me know. You can message in the chat box. Better if you ask me directly. Yes, Viral.
So, sir, here we have the curtailment without settlement. Do we also expect curtailment question with settlement with in
Yes.
the exam?
Yes, there is a question on curtailment with settlement also. There the amount is paid. So we'll be looking at one such question.
Okay, okay.
Yeah.
One more question can I ask right now?
Yeah, please, please.
Okay, so if there is curtailment, there would be change in the present value of plan obligation. So this
Yeah.
curtailment happened within throughout the year or in the mid of year. So do we also have any impact on interest portion or any other portion?
Ideally, yes, you will have there will be an impact on the interest portion. Unfortunately, that is not covered in our uh, SBR syllabus. But there,
Okay, okay.
if that, see, rarely ever will it happen at the beginning or the end of the year, right? It will usually happen at any point in time.
Mm-hmm.
So that will definitely have an impact on the interest calculation.
Okay,
But it's not there in our syllabus.
okay, okay. Okay. Thank you.
Okay. Okay. Now, whenever you have a figure for benefits paid, So for example, I have to pay an amount of 5 lakh rupees to Viral, which is the amount that was promised to him. Now, that money is not lying in my bank account. Now, I have invested that money in some plan assets. So when I know that the due date for making payment to Viral is there, what I will do is I will sell the plan assets. I will liquidate the plan assets. There will be an entry, bank account debit to plan assets, 15 million. Okay. Now the value of plan assets goes down by 15. And how much do I have to pay to Viral? I have to pay 15 million to him. So when I settle the obligation, my entry is plan obligation account debit to bank account. So at the time of settlement of the benefits paid, whenever I'm making the payment, I'm first of all liquidating the plan assets. So value of plan assets is going down by 15 and my obligation is also reducing by the same amount. Because my obligation and my plan assets are reducing by the same amount, the net value of benefits does not change. See, present value of net obligation before payment of benefits was 20 and at that time my obligation was 100 and my plan assets were 80. Now I sold plan assets worth 15 तो कितना हो गया मेरा plan asset 65 हो गया. Okay, and my obligation figure also reduces by 15. It was 100 earlier. 100 minus 15 is 85. Difference between 85 and 65 is 20. So basically, the fact of payment of benefits to the ultimate recipient, that does not change my net obligation because my plan assets and the value of my obligation both reduce by the same number. Now, the situation that somebody was asking me about, what would happen if the value of plan assets is more than the amount of plan obligation? Where assets are more than the obligation, you have a net asset position. See, usually the obligation is always more than the asset value. Because the obligation is always more than the asset value in like 95% of the cases, we have a net deficit position. What you have to pay is more than what you have in your pocket. Now, there is a possibility in some rare circumstances that the value of the plan assets is more than the amount of obligation. So you have a net asset position in that case. Now we are all, see, we follow the prudence principle. We want to be extra careful, extra cautious. So we never explicitly state the amount of, so we always try to make sure that we never overstate the assets. So when there is a surplus in a defined benefit plan, if the defined benefit plan is in surplus, then IAS 19 states that this surplus should be measured at the lower of amount calculated normally and total of present value of any economic benefits available in the form of refunds from the plan or reduction in the future contributions to the plan. By the way, this figure, total of present value of refunds or future reductions from the plan, this will always be given to you in the paper. Now, what is this? Say, for example, the benefit promised to an employee is 5 lakh rupees. And you collected money and you deposited that or you invested that in a lot of uh, high return securities. So the securities delivered you a high return, which is why in the next year or in the third year, you collected a lesser contribution from employees because the return was more than enough. In that case, this is the calculation that you are arriving at. Reduction in the future contributions to the plan because of the returns generated. What happened in this case is because of the bumper returns generated by the plan assets, my future contributions to the plan were reduced. Think about it this way. Say, for example, you want to pay something on Zomato and you have a scratch card or you have a coupon code with you. When you apply the coupon code, the 1,000 rupees bill reduces and becomes, say, 800 rupees. So what is this 200? This 200 is reduction in the future payment that you have to make. So that is the number ideally that we are trying to calculate for a pension fund or for a defined benefit plan. So the surplus in the plan should be measured at the lower of amount calculated normally and present value of any future reductions from the plan or present value of any refunds that you might get. Now, the good part is this amount you don't have to calculate. This will always be given to you in the paper. Okay. And we'll see a question to understand how it works. And then, of course, there are termination benefits. What is the meaning of the word termination? Termination is bringing something to an end. Now, if you are, say, for example, firing an employee, and when I say you are firing an employee, it's only because his services are no longer required. Okay. Now that his services are no longer required, what you will do is you will have to somewhere consider the fact that after making this particular decision, the future contributions to the plan are going to get affected in some way or the other. Now, how that particular situation affects your calculation, we'll have to understand that. And are there any well-defined rules that guide you on termination benefits? Let's understand that as well. For example, see, usually when does this happen? When the entity is trying to go for an overall restructuring. One vertical is being shut down. We had 4 locations and 1 location we are shutting down. So now in this case, how should I account for the employee benefits? The reporting entity should recognize an expense and a liability in relation to termination benefits at the earlier of the following dates: when the entity can no longer withdraw the termination benefits offer, or when the entity recognizes restructuring cost as per IAS 37. So, termination benefits, I have 4 locations in India and I want to shut down the South India branch in Bangalore, maybe. So, I should, and of course, when I shut down that branch, several employees from that branch are going to lose their jobs, and I might have to pay them a certain extra amount when they are leaving the organization. So, this extra amount that I have to pay them when they are leaving the organization is my termination benefit, and it has to be recognized at the earlier of uh, when the entity can no longer withdraw the termination benefits offer, or when the entity recognizes restructuring cost as per IAS 37. Earlier of the 2 dates, you should be recognizing the payable in case of termination benefits. Okay. Now, the examination questions have not tested termination benefits so much, but they have definitely tested the asset ceiling part. So we look at one example to quickly revise the asset ceiling bit. Okay, have a look at this question. ARC has, okay, the following information relates to the defined benefit plan operated by ARC for the year ended 30th June 2004. Fair value of assets brought forward is 2600. PV of obligation is 2000. So what is the value of net assets? Net assets are 600. Current service cost 100, benefits paid 80, contribution to the plan 90. Fair value of plan assets at 30th June 2004 is 3100. That is end of the next year. And present value of obligation is 2400. Discount rate is 10%. ARC has identified that the asset ceiling at 30th June 2003 and at 30th June 2004, based upon the present value of future refunds from the plan and or reductions in the future contribution, is estimated to be 200 at 30th June on both the dates. Okay. Before the asset ceiling, the obligation was 2000, the assets were 2600. 2000 minus 2600, you had a net asset position of 600. But the asset ceiling based on the present value of future refunds was capped at 200. So 200 is the cap post ceiling. Before recording the asset ceiling, you had a value of net assets of 600. So you adjusted 400. So make a column called the asset ceiling column and adjust the amount of your net assets value after the asset ceiling. After the asset ceiling, the max you can have is this 200. Okay. Now, with that in your kitty, then do the other calculations. Calculate 10% interest on the net obligation. Then calculate current and past service cost is given to you. Add that. Subtract 90, which is contributions into the plan. So as per the pre-ceiling values, the value of obligation comes to 650. Now in this 200, which is the see ye jo values hai, mirror those values here. Okay, current and past service cost will not change, contributions into the plan will not change, but yes, interest on net obligations, this will change. On 200, you will calculate 10%, which becomes 20. And what is the net book value of the obligation? The net book value is 210. But how much is the asset ceiling imposed? The asset ceiling imposed is 200. So although the value of net assets is 210, you have to show it, you have to cap it at a number of 200. So again, there is a remeasurement component. The carrying amount of an asset is 210, but you are being forced to record that at 200. The difference goes to your remeasurement component, which is routed through other comprehensive income. So in a question on asset ceiling, remember one thing, prepare one column which is called before the asset ceiling column, in which case all the calculations will be as usual. Then prepare a column called the asset ceiling column where you will have to cap the amount of net assets, which in this case was capped at 200. Okay, write this at 200 and write down the adjusting figure here in the asset ceiling column and then perform the remaining calculations. Yes, Ritika.
So why is that 200 taken as negative figure, sir? So
Because it is, see, in most cases, what we have done, wherever we were doing a defined benefit plan, we were always, we always had a situation where the obligation was more than the asset. So we were showing all liabilities with a positive sign. All expense also we were showing with a positive sign. I could very well have changed the signs, but then, all the other figures, unka sign also will change in that case. So I thought ki if it is an obligation, I will show it with a positive number. If it is an asset, I will show it with a negative number. Because how do you calculate the number? It is obligation minus asset. So 2000 minus 2600 is minus 600. But here, this minus 600 is your asset value. So when you write minus 600, that means you have an obligation of minus 600. That means you have an asset of 600.
okay, sir.
Okay. So this adjustment is often tested in your there is a question, I think it is Apka Columbia company, not very sure. In one of the questions now you have this situation where there is an asset ceiling adjustment and then you have to consider the entire calculation. Could 7, 8, 6, 7 marks ka adjustment is there in one of the questions. Cool. So that is the long and short of IAS 19. We of course took how many hours? I think we took 6 to 7 hours while doing employee benefits in the regular class. But naturally अभी revision करना है तो थोड़ा सा the focus will be on completing the concept and questions, of course, you will have to see. I have put out some of the questions in the revision wala kit. You will have to go through those questions if you want to understand how the concept of employee benefit works and different questions that can be asked on that. Now, the next topic that we have is share-based payments. Share-based payments पे ना इतने सारे questions I haven't seen in the exam kit. So it's not tested so frequently, but I think that Kimimila company's question, I think that had a performance condition very closely connected with with climate change or something. तो ऐसा hybrid type of question आया था. So it's necessary that we have a look at it once. So what are share-based payments? Share-based payments are payments where the amount payable is settled by way of shares. Okay, these are not necessarily payments against shares, but these are payments which are settled either in shares or using the value of shares as the basis. Okay, so what are share-based payments? These are either payments that are settled by issuing shares or payments that are settled using the shares as your base value. So that is where the idea of different types of share options comes into play. Whenever we are talking about share-based payments, remember it doesn't mean that the payment has to be settled by issuing equity shares, but the payment can be settled by using a value calculated on the basis of equity shares. Okay. So let's have a quick look at IFRS 2 and how does that accounting take place. I have another question. When there is a change in percentage of finance cost and employee benefit, is there any retrospective accounting? See, If the question specifically mentions that the benefit has to be paid retrospectively, then you consider retrospective benefits. Otherwise, there is no need to consider any retrospective benefit. Okay. Okay. Is I'm facing a minor issue in my internet. I need to switch my network. Give me 1 second, okay? Okay. IFRS 2 applies to all the share-based payment transactions. Now, there are two types of share-based payments that we have in our syllabus. One is an equity settled share-based payment. The second one is a cash settled share-based payment. In equity settled share-based payments against the goods or services that you have taken from the other party, you issue them shares or you issue them share options. इसमें एम्प्लॉइज वाला पार्ट हम अलग से देखेंगे. First thing that the first type of share based payment is an equity settled transaction, but usme bhi there are two subcategories. Okay, so whenever, say for example, there is a consultant who gives me some architectural consultancy services. Now I don't have cash to pay him, so what I do is I issue equity shares of my company to this person. Okay, I issue equity shares of my company to this person. So in this case, I am settling the transaction in shares. Okay, I am settling the transaction in shares, hence it is called share-based payment. Now, is the transaction with employees or others providing similar services? If the answer is yes, the transaction is with employees or with someone providing similar services, then measure at the fair value of equity instruments at grant date. Is the transaction with employees or others providing similar services? If the answer is no, then can the fair value of goods and services received be reliably measured? If the value can be reliably measured, then measure at the fair value of goods and services received at the date they were received, or if the answer is no, then measure at fair value of the equity instrument at grant date. Now let me explain this using an example. There's a person called Satyamed. He is an employee of Plutus Education who teaches ACCA subjects here. There is another person called Chinmay who is a consultant at Plutus Education. He is not an employee, he is a consultant. And he also teaches ACCA. What is the question? Is the transaction with employees or with someone providing similar services? Now, Plutus Education wants, against the services offered or provided by Chinmay, Plutus Education wants to provide Chinmay with certain, instead of paying him cash, they want to settle the transaction by giving him shares. So in this case, Chinmay is not an employee, but he is providing services similar to an employee. Satyamed is an employee who teaches ACCA. Chinmay is a consultant, an outsider, a freelancer who also teaches ACCA. Is the transaction with employees or others providing similar service? If the answer is yes, then measure at the fair value of equity instruments at grant date. If there is another person called Bhavik who supplies stationery to Plutus Education. Now, in this case, is the transaction with employee? No, he's a stationery shop owner. He's not an employee. Is the transaction with someone providing similar services? No, he doesn't provide services similar to an employee. Then in that case, you go down this route. Can the fair value of goods and services received be reliably measured? If the answer is yes, measure at the fair value of goods and services at the date they were received. If the answer is no, then measure at the fair value of the equity instruments at the grant date. See, normally when you record an expense, say for example, when you record a rent expense, what entry do you record? You record rent account debit to landlord and landlord to bank. So you settle the obligation in cash, hence it is called a cash-based payment or cash settled payment. But instead of paying cash, if you are giving a equity or if you are giving options to the other person, then in that case, it is called a share based payment and the entry is rent account debit to landlord, landlord account debit to equity. Now, two simple questions for us to basically get this rule in place. Okay. इसके लिए two simple transactions we have. On 1st of Jan 2008, Liminal purchased a patent. The fair value of the patent was reliably estimated to be 3 million. The consideration transferred was 1 million of Liminal's own $1 ordinary shares. On the purchase date, the patent had a remaining useful life of 3 years. The fair value of one of Liminal's ordinary shares was $3.5 on 1st of Jan 2008 and $3.2 on 30th June 2008. Discuss the accounting treatment. Now, what did Liminal purchase? Liminal purchased a patent. First question, is the transaction with an employee or someone providing similar services? आपको employees usually don't sell patents to you, na? So the transaction is not with someone who is providing similar services. So the answer is no. Then ask the question, can the value of goods and services received be reliably measured? The consideration, the fair value of the patent was reliably estimated to be 3 million. Can the fair value of goods and services be reliably measured? Yes. Measure at the fair value of goods and services received at the date they were received. Okay. So this entire transaction will be recorded at 3 million, which is the fair value of goods and services on the date that they were received. So what is the accounting entry? The accounting entry is patent account debit 3 million to share capital. How many shares were issued? 1 million shares were issued. Okay, face value is $1. So 1 million into 1 share capital is credited with that. And what is share premium? Share premium is the amount over and above the face value. In this case, because the fair value of the item received could be measured reliably, the transaction was recorded at the fair value of the item received, which is 3 million. Okay, now let's look at a variant of this question. Okay, on 1st of Jan 2008, Liminal purchased a patent. The fair value of the patent cannot be estimated reliably. The consideration transferred was 1 million of Liminal's own $1 ordinary shares, and on the purchase date, the patent had a remaining useful life of 3 years. The fair value of one of Liminal's ordinary shares was $3.5 on 1st of Jan 2008 and 3.2 on 30th June 2008. The question you need to ask yourself is, can the fair value of the goods and services received be measured reliably? If the answer is no, then measure at the fair value of equity instruments granted at the grant date. What is the fair value of equity instruments on the date of grant? It was granted on 1st of Jan, and on that date the fair value was 3.5. What is the accounting entry? The accounting entry will now be done at the fair value of the shares received, which is 3.5. So 1 million into 3.5, 3.5 million पे record होगा. Patent account debit 3.5 million. To share capital 1 million. To share premium 1 million into 2.5. ठीक है? Are you with me, all of you?
Yes,
Yes,
sir.
sir.
Okay.
Yes, sir.
This is a simple share-based payment transaction. Apart from that, there are other transactions which are tested in the paper, which is basically the most common one is employee stock options. Now, what is employee stock option? An employee stock option is like a perquisite that is given by the employer to employee. Now, this is frequently used by startups in order to attract and retain top talent. Say there is a startup which wants to basically hire a lot of senior talented employees, but it doesn't have the cash ability to pay them. So what it says is, Satyamed, you join us. Your salary expectation is 60 lakh. Great. We'll pay you 50 lakhs right now in cash. The remaining 10 lakh we will give you in the form of shares. Okay. And you will not get the shares immediately, but you will get the permission to purchase the shares at a substantially lower price if you continue working with us for the period of 2 more years. So you join on 26th of August 2025, you work with us for 2 more years, then you will get the facility to purchase shares worth 10 lakh rupees by paying 10,000. So from Satyamed's point of view, who is an employee, this is like a game. Something worth 10 lakh rupees, he is getting that for 10,000. And from the company's point of view, think of it like a loss, because had the company issued these shares in the open market, it would have received 10 lakh rupees. But because it issued these shares to Satyamed under the employment agreement, the company got only 10,000 rupees for something whose value is 10 lakh. So the company incurred a loss, and this loss has to be accounted for in the books of accounts. That is the primary idea behind share options. Okay, so before we go into a question or before we go into a further discussion on share options, I would want you to quickly read this. एक बार इसको देखो आप and then we'll go deeper. ठीक है, एक बार quickly read this. Okay, now an entity has a yes, you need to read. देख लो, no problem.
Few seconds, sir.
Sure, take your time, no problem.
Done, sir.
Okay, everyone.
Yes.
Yes, sir.
An entity has a reporting date of 31st of December. On 1st of Jan, it grants 100 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st of December 2003. At the grant date, the fair value of each share option is $15. Now, share options granted to employees should always be accounted for using fair value at grant date. During 2001, 20 employees leave, and the entity estimates that a total of 20% of the 500 employees will leave during the 3-year period. Now, what is the basic idea that 20 employees have left, and how many more do you expect that will leave you in the next, in a span of 3 years? Total 20% of the employees will leave you. Now, during 2002, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 will leave. And then during 2003, a further 10 employees leave. Remember one thing, the amount of expense that you record for with respect to share options should be should be based on the estimated number of employees to whom you will have to give the share options. Now, you started with 500 employees, 20 left during the year 2001, and out of 500, the company estimates that overall 20% will leave by the end of year 3. So, while you started off with 500 employees, while you granted the share options to 500 employees, see, only those employees who are in the service of the company on 31st of December 2003, only they will be eligible to get the share options. Okay, so although the grant has been given to all the 500 employees, only those who stay with the company till 31st of December 2003, only they will get to exercise the share option. So how many employees do you think will stay with the company till 31st of December 2003? 500 minus 20%, which is 400. So on 31st of December 2001, what the company will think is that, you know what, there are 400 employees according to us who will stay with the company, and each of these employees has been given 100 options each. And what is the fair value of options? The fair value of options is 6 lakhs. So by the end of year 3, we should have recorded a total expense of 6 lakhs. But see, this is total expense for a period of 3 years. We are standing at the end of year 1. So how much expense should we record in the current year? 6 lakh divided by 3. We should have recorded an expense of 2 lakhs in the first year. What will be the accounting entry? The accounting entry will be employee compensation expense account debit to equity account. Now, in your ACCA books, they have used the term equity account everywhere, but in real life, we often find, ESOP outstanding, that is employee stock option outstanding, या फिर usually find that account equity कम दिखता है आपको. We cannot credit equity share capital because let's face it, no equity shares have been issued so far. Now, so this was the situation in 2001. Now I have arrived on which date? Now I have arrived on 31st of December 2002. Okay. We started off with 500, 20 left in 2001, 20 left in 2002, a further 20 left. And the entity now estimates that only 15% of the original 500 employees will leave during the 3-year period. So as per the revised estimate on 31st of December 2002, the company believes that out of these 500, only 15% would have left the company. So how many employees do you expect will remain with the company? 425 employees, I think, will remain with the company by the end of 2003. And only those who remain with the company by the end of 2003 will be allowed to exercise the options. Each of these employees has been given 100 options each. And what is the fair value of each option? The fair value of each option is 15. So by the end of year 3, the total expense that I should have recorded is 637,500. Proportionately, by the end of year 2, I should have recorded 2/3 of this expense, that is 4,25,000. I have already recorded 2 lakh in year 1. How much do I need to record additionally in year 2? I need to record 2,25,000 additionally in year 2. ठीक है. एक बार quickly have a look at the explanation for year 2002. एक बार यहाँ पे देखिए. Read it carefully. If you are getting stuck anywhere, ask me please. Done?
Yes, sir.
Okay. Chalo. Let's look at the last year. In the last year, during 2003, a further 10 employees leave. Now, on 31st of December 2003, you have a complete idea of how many people have remained with the organization. You started with 500, 20 left in 2001, 20 left in 2002, and another 10 left in 2003. How many are remaining with the company? 450 remain with the company. Each one of them has been granted 100 stock options. And what is the fair value of the options? 15. So your total expense should have been recorded by the end of year 3, 675. You recorded 2 lakh in year 1, then you recorded 2,25,000 in year 2. How much more should you record in year 3? You should record 2,50,000 as an expense in year 3. Okay. Have a look at the calculations for 2003. Read it once.
Sir, so it is only at the final year of the calculation that we use the actual number of employees who are actually left, right?
Yes, that is the actual number. At the end of year 1 and year 2, you only have a projected number.
So all of those places, we only use the estimate percentage.
Yes.
Okay, sir.
Yes, Ishan.
So then why did we subtracted 20 employees, which was during the year 2001, which we left in the year 1?
We did not subtract 20. See, we needed you're talking about the calculation in year 3?
No, sir, I'm asking in year 1,
Huh.
there were 20 employees which left. So
Yeah.
why didn't we subtracted that?
Because see, although 20 actually left, the provision that I am creating That provision should be based on the number of employees who are expected to exercise the option. Although 20 actually left during the year, only those employees who stay with the company by the end of 2003, only those will be allowed to exercise the option. So how many are expected to leave by the end of 2003? 20% are expected to leave. That means how many are expected to remain in the organization? Only 400 are expected to remain in the organization. If we do 500 minus 20 and we say 480, this calculation will be incorrect because these are the employees who are there with the company on 31st of December 2001. But to determine the amount of share-based payment or to determine the amount of employee compensation that we have to record, we don't need employees on 31st of December 2001. We need the employees expected to remain with the company on the date of 31st of December 2003 when they become eligible to exercise the options.
Understood, sir. Thank you.
Welcome. With this one question, there are a couple of terms that you should be aware of. One is the exercise price. What is exercise price? The fixed price that you will pay in the future to purchase a share of the company. The vesting date is the date on which the counterparty becomes entitled to receive the cash or the equity instruments. So I joined the company on 26th of August 2025. I have to serve the company for 2 years. That means on 26th of August 2027, I will become eligible to exercise the share options. That date is my vesting date. And what are vesting conditions? These are conditions that I need to fulfill in order to receive cash or equity instruments. It's in most cases, it will be a service-based condition. In some cases, it could be a performance condition also. We'll see what performance conditions are. And grant date is the date on which the options are granted to the employee. Now, in this tab, you have a calculation which talks about how to determine the amounts for each year. I have assumed a 3-year period and I have written down the steps for you. You can go through this. If you follow the steps as it is, at least questions of this type, you will never get those wrong. Okay. There, see, while we have service based conditions where the employee becomes eligible to purchase equity shares on the fulfillment of certain conditions, you could also have some performance based conditions which could be classified into two categories: market conditions and non-market conditions. Market conditions, they take into account when determining the fair value of the grant date, and not market conditions, they are taken into account at each reporting date when estimating the number of options likely to be while estimating the number of options that are likely to vest. Now, what are market conditions? So in one way, you could be told that, listen, Satyamed, if you work with the company for 2 years, you will become eligible to exercise the option. In another way, they could impose a condition that, Satyamed, you will become eligible to exercise the option only if the share price of the company goes beyond 20 rupees per share. That is a market-based condition. If that gets fulfilled, if the share price goes beyond 20, then I become eligible to exercise the share options. Or I could have a non-market based condition. What is a non-market based condition? It is taken into account at each reporting date when estimating the number of options likely to vest. See, market based means it is based on the share price of the equity instrument. A non-market condition is that, Satyamed, you will become eligible to exercise the share option provided the total turnover of the company goes above 100 crores. See, that is internal number. That is not a market-based number. A market condition is related to the share price. Okay. Now, what is the impact of these performance conditions? Market-based conditions have already been factored into the fair value of the equity instrument at grant date. Therefore, an expense should be recognized irrespective of whether the market-based conditions are fulfilled or not. So there will be questions where they will say that in order to become eligible to exercise the options, the market price has to be more than $5 per share. And there is a possibility that the market price will not exceed $5 per share. In that case also, an expense is recognized irrespective of whether the market condition is fulfilled or not. This is because the fair value already incorporates the probability of the condition getting fulfilled. Non-market conditions, while deciding that, you should pay attention whether the condition is fulfilled. If the condition is fulfilled, then you should exercise the option. If it is not, then you will not be allowed to exercise the option. Now, see, the proof of this is A, beyond the scope of your SBR syllabus, and second, right now we don't have the time to go into the detailed logic of why or how do you consider that the fair value of the equity instrument incorporates the market based condition. वो सब डिस्कस करने का टाइम अभी अपने पास नहीं है. So all you have to do is you have to keep this in mind that even if a market based condition is not fulfilled in a particular question, an expense should be recorded. And if it is a non-market based condition, then check करो अगर condition fulfilled तो record the entry for exercise, record the entry, otherwise don't. This part I'm deleting because right now we don't have the time to go into that. Plus, it's not relevant from an examination perspective. Have a look at these two questions. These are based on market and non-market based conditions. I'm not deleting it. I want you to go through the two questions and they are basically based on these only. Plus, I have written like a detailed explanation for every single calculation that is done here. So it is based on what you learned here in question 2 and what you learned here in the performance conditions wala tab. You can do question 3 and 4 based on that. Now, what happens at the exercise date? So there is a date on which the vesting conditions get fulfilled. After that, the employees have an option. If they want, they can purchase the equity shares, or if they don't want, they can just let it lapse. And it's not to be exercised on that date. There is an exercise window. So if I fulfill the conditions on 26th of August 2027, uske baad I get 6 months in order to exercise my options. Okay. After that particular date, I get 6 months to exercise my option. That period is known as my exercise window. It could change from company to company and scheme to scheme. But if the options are exercised, the accounting entry is bank account debit, equity account debit to equity share capital to share premium. Bank account is debited with amount received. Equity account is debited with the amount credited to this account in the past. Share capital is credited with number of options exercised into face value per share. Share premium is credited with the balancing figure. Okay, learn this entry. I mean, it's a simple entry. Just follow this entry into your question and you will get your answers. If the options are not exercised, that means the company is not issuing shares. Just close that particular account, record an entry equity account debit to retained earnings, and your job is done. Now, you could have a different type of share-based payment options, which are called as cash settled share-based payments. In this case, the approach is slightly different. What is the approach? Instead of issuing equity shares, you promise the other person that I will give you an amount which is equivalent to the change in the value of shares. How does it work? Say, for example, Mayank wanted to join a class with me. And he said, Satyamed, I don't have the money right now. Can I join? I said, no, you can't join. You have to pay me. So Mayank says, I will pay you in an interesting way. Today, the value of one equity share of Reliance is 1500. I said, yeah, it is 1500. So whatever is the difference in value between today and the date of payment, I will pay you that difference in value. I will not give you equity shares of Reliance, no. But say today the value is 1500 and after 1 year the value is going to be 3000. Mayank tells me कि whatever is the difference in the value of equity shares between today and that particular date, that much amount का cash equivalent I will give you. Okay, that much amount ka cash equivalent I will give you. So see, this is not a payment made in shares, but this is a payment whose value is derived on the basis of shares. Hence it is called, this is also a share based payment, but you are not issuing equity shares. You are paying cash in cash to the other party. Hence these are called cash settled transactions. We also call them as share or stock appreciation rights. Okay, now for a stock appreciation right, every year, what entry do you record? Year on year, you record a simple entry, P&L account debit to liability for SAR. Okay, because see, this is not equity, you only have to pay cash to the other person. So year on year, you record the entry P&L account debit to liability for SAR. How do you calculate the amount to be debited? Total employees minus employees who left minus employees who are about to leave into options per employee into fair value on the reporting date into number of years lapsed divided by total year. Year on year ये entry record करो at the end of whatever 3 years, 4 years, whenever the vesting happens, and on that date, you have to pay the amount to the employee, record the entry liability for SAR account debit to bank account. Okay. The accounting entry that you should record at this stage is liability for SAR. What is SAR? SAR is stock appreciation, right? So how is the entry recorded? Because see, now you are making the payment to the other party, right? When you are making the payment to the other party, how do you record the transaction? The transaction is recorded as liability for SAR account debit to bank account. Now, based on this, you can be asked a couple of simple questions which have been given to you in question 7. Now, there is one topic that ACCA has removed in a way from the SBR syllabus, and they have never really asked a question on that, and that is on hybrid instruments. Okay, so I'm not going to go into a lot of detail on these hybrid instruments because ACCA has removed, but in a couple of cases in other papers, now what they have done is एक other topic they have removed, but kahin na kahin they are asking a question on that. So I don't want to take a chance. So I will still discuss the hybrid instruments wala concept with you. But please know कि इसके आने का chance is like less than 1%. We are doing it because till last attempt it was there. Now they have removed it, but last attempt तक था syllabus में. So just to be on the safer side, I want to cover this concept, which is hybrid transactions. If a share-based payment transaction gives the entity a choice over whether to settle in cash or by issuing equity instruments, IFRS 2 states that the scheme should be accounted for as a cash-settled share-based transaction if the entity has an obligation to settle in cash. If no obligation exists to settle in cash, it is called as an equity settled share-based payment scheme. Now, let's talk about, see, this is what they used to ask in the past. Matlab they had included in the syllabus. Pucha kabhi nahi tha. So they had included a situation of counterparty choice. Understand what is the situation. Some entities enter into share-based payment transactions that give the counterparty the choice of settling in cash or in equity instruments. In this case, the entity has granted a compound instrument, and so the credit entry must be split between equity and liabilities. Now, see, we have discussed compound instruments and financial instruments. This is a situation where the entity has issued stock options to the employees, and the entity has given a choice to the employees that if you want, you can get cash against it, or if you want, you can get equity shares against this particular stock option. If the transaction is with employees, the equity element is calculated as the fair value of the equity alternative at the grant date less the fair value of the cash alternative at the grant date. If the transaction is not with employees, the equity value is calculated as the fair value of goods or services received less the fair value of the cash alternative at the date of the transaction. Less chance of the question asking you for entity choice. Agar 0.1% probability they ask, it will be the counterparty choice. Again, I am repeating, this part has been removed from the syllabus. ठीक है, एक बार, but we'll have a look at one simple question. On Jan 2004, an entity grants rights to 20 employees. If still employed on 31st of December 2006, 4, 5, 6, 3 साल तक if you stay with the company, you will get stock options. If still employed on 31st of December, the employees can elect to receive either 800 options or cash to the value on that date of 700 shares. The fair value of the options is $19 at the grant date. The reporting date is 31st of December. Calculate and explain the impact of the share-based payment on the financial statement for each of the 3 years. See, who has the choice? Employee has the choice, which means we are talking about this situation. Counterparty choice का बात हो रहा है यहाँ पे. ठीक है. In case of counterparty choice, equity element is calculated as fair value of equity alternative at the grant date less fair value of cash alternative at the grant date. What is equity alternative at the grant date and what is cash alternative? Employee has a choice. He can either elect to receive shares, equity element, or he can opt for receiving cash. Naturally, every employee will do or he will pick that option which is more beneficial for him. But when will the decision be made? This decision will be made only on the exercise date. On the grant date, और throughout the period, the company has no way of knowing कि एम्प्लॉय क्या करेगा. तो हाउ डज द कंपनी कैलकुलेट द इक्विटी एलिमेंट? पे अटेंशन. इक्विटी एलिमेंट दे टोल्ड इज difference between is calculated as fair value of the equity alternative less fair value of the cash alternative. What is fair value of equity alternative? यहाँ पे क्या लिखा है? If he goes for shares, he will receive 800 options. ठीक है, he will receive 800 options. The fair value of options is $19 at the grant date. What is the fair value of then the entire equity element? 800 options into 19 per option minus fair value of the cash option. 700 shares into cash option means on that date, if you sell the shares, how much money will you get? You will get 21. So you calculate the difference as 800 into 19, which is the fair value of the equity element, and then fair value of the cash element. 700 into 21, which gives you an equity element of 500 per employee. On the grant date, what is the share price? The share price is 21. If anyone were to buy or sell shares on this date, they would have to do that at 21 per share. So which is why, fair value of cash option ko humne pakda hai 21. What is fair value of any item? Fair value of any item is the amount you would get on selling the item or the amount you would receive on selling the item is the fair value of that particular item. So we considered that ये जो 500 है, this 500 has to be difference between the two, 500 per employee. This has to be treated like an equity settled share based payment. कितने employees? 20 employees. So total expense and liability to be recorded over 3 years, 20 employees into 500 per employee, that is 10,000. Expense to be recorded in year 1, 10,000 upon 3 this is the equity element, 3333. Now, how do you calculate cash element? क्या बोला है इसका? Cash element is calculated. Naturally, cash element will be the other part of it, right? They have given you a guidance on how to calculate the of the equity element. Employees have been promised cash equal to 700 shares. In year 1, 20 employees are expected to vest. What will be the liability for cash element in total amount in 3 years? 700 shares into 20 employees into 31st of December 2004, the share price is 27. अब on 31st of December, आपको you don't know कि what will be the share price on 31st of December 2006, but you do know what is the share price on 31st of December 2004, which is the end of the year. So how will you calculate the value of the cash element? 700 shares into 20 employees into 27 per share, $27 per share. ये 3 साल का एक्सपेंस है. 1 साल का एक्सपेंस कितना होगा? 3,78 into 1/3, that is 1,26,000. You will have to repeat the same procedure year on year. Please understand how exactly are we doing it. If we want to calculate the equity element, you have to calculate the difference between two things. The fair value of equity option and the fair value of cash option. Fair value of equity option is kitna shares? 800 options. And what is the fair value? 19. And what is the value of the cash option on 31st of December? The value of the cash option is 700 into 21. ठीक है. So you calculated this amount and you got an amount of 500 per employee. उसको आपने 3 years में distribute किया. You got expense to be recorded in year 1. This is the equity element and cash element कैसे calculate किया 700 into 20 into 27 divided by 3. ठीक है, are you with me all of you?
Yes,
Yes,
sir.
sir.
Yes, sir.
एक बार year 2 देखो, just have a look at year 2 equity element. अच्छा, एक और डिटेल है यहाँ पे that by the see 31st of December 2004 को 20 people were there. Next entry will be recorded on 31st of December 2005. उस डेट को कितने लोग हैं? There are 18 people left in the organization, right, who are expected to exercise the option. Have a look at year 2. Mayank, Garvit, anywhere you have a doubt, please let me know immediately. देख लो, अच्छे से देख लो. Anywhere, any calculation, Himanshu, Garvit, Farha, Ankita, anywhere you have a problem, please highlight that to me immediately, okay? Have a look at it.
Done, sir.
Done. Mayank, कुछ पूछना है?
No, sir.
एक बार ये कैश पार्ट देख लो. For the cash part, see, whenever you have equity settled share based options, उसके लिए you consider the fair value at grant date. But whenever you have cash settled a transaction, then you have to take the fair value on each date, which is what we were doing in the SAR questions also. ठीक है. Now, that's pretty much the long and short of IAS 19 and IFRS 2. We have revised the entire standard. The questions of the exam kit, that analysis also I had done, but we are falling short of time for doing that. So what I can do is tell me if the idea works for you. I think I'll make a short recording of those questions and I will upload that on the channel later in the day because now I have to get into another class. These are all exam kit questions. I'll show you. I have the PPT ready with me. And unlike financial instruments, it's not such a big calculation. Sorry, it's not such a big sheet. So, my sheet, though, of course, I will share it with you, no doubt about it. But if you want, I can upload a small session on. So there is a pension plan in layout company question. There is a pension plan in Columbia company. Then there is one in sugar company. Then there is one in Ecoma. And then there is one in DigiWire. So if you want, I can record a brief video for these and upload it for your reference. Do you want it?
Yes, sir.
Yes, sir.
You'll have to say, huh? आप बोलोगे तो मैं कर दूंगा.
Yes,
Yes,
sir.
sir. Yes,
Okay.
sir.
Yes, sir.
And today I will be free at 11 p.m. 11:15 को मैं फ्री हो जाऊंगा from my other classes. So those of you who want to discuss the study plan or whatever, because you still have 1 week for SBR, so if you want, I can send you a link for 11:15 p.m. today, and you can join the session and we can discuss your individual issues and points there. Does that work?
Yes, sir.
Yes,
Yes,
sir.
sir.
That works.
Yes.
Right, I'm stopping the recording now. Thank you so much, but I'm not exiting, just stopping the recording.